Every founder thinks they need to be a genius to raise money, but the real genius is keeping it once the tax man shows up. We're talking about a game where the difference between a smart raise and a stupid one can cost you millions, and nobody teaches you this in business school. Let's talk about why capital raises go sideways from a tax perspective. And it almost always comes down to one thing: structure. When you raise money the wrong way, the IRS doesn't just take a cut, it takes a seat at your board meeting, permanently. Think of your company like a pipe carrying water to investors, and the government is standing there with a wrench ready to reduce your flow at every joint. The technical term is tax drag, but the practical term is ouch, and it compounds every single year you ignore it. There was a moment, not long ago, when SPACs were the darling of every founder who wanted to go public without the headache of a traditional IPO. Then the tax bills hit, the lockup periods expired, and suddenly those same founders were staring at ordinary income rates on what they thought were capital gains. Welcome to the party. Hope you save some cash. The psychological whiplash of going from we raised $20 million to we owe the government $6 million is genuinely traumatic. And behavioral economists will tell you that pain of loss hits twice as hard as the joy of gain. So when conviction starts to crack after a raise, it's not weakness, it's math. Here's the historical pattern that keeps repeating. Founders raise equity, dilute themselves, trigger phantom income events, and then discover that their advisors were optimizing for the deal closing, not for their long-term tax position. We've seen this cycle play out from the dot-com era through the crypto boom, and the actors change, but the script stays the same. Capital raises fit neatly into a boom and bust psychological cycle where urgency overrides diligence, and that's exactly when the most expensive mistakes get made. The community wisdom from experienced operators is almost universal. Slow down on structure, speed up on due diligence, and never let FOMO drive your formation decisions. One of the biggest misconceptions is that raising debt is always worse than raising equity. But from a tax standpoint, debt can actually be a founder's best friend because interest is deductible and there's no dilution event. Equity raises, especially convertible notes that trigger at the wrong moment, can create taxable events that feel like a trap you accidentally built yourself. The practical lesson from the last 40 years of startup finance is shockingly simple. Use qualified small business stock exclusions under Section 1202, structure early raises to maximize the 10-year holding period, and treat your cap table like a tax document from day one. Moderate your raise size, stay disciplined about when you convert instruments, and remember that patience with structure pays dividends that no pitch deck can match. Here's the philosophical truth that every seasoned investor already knows, but every first-time founder has to learn the hard way. The deal isn't done when the wire hits, the deal is done when you file your taxes. Discipline in structuring, sizing your raises appropriately, and maintaining consistency in your capital strategy will outlast any single funding round. And look, if you're comfortable with the idea that some raises will be messier than others, that's actually a healthy mindset. Because rational preparation for tax consequences means you've already war-gamed the downside. The founders who sleep best at night aren't the ones who raised the most. They're the ones who kept the most of what they raised. The irony, of course, is that we spend months perfecting our pitch decks and approximately 45 minutes thinking about tax structure, which is genuinely backward if you do the math. A 1% improvement in your tax efficiency on a $10 million raise is worth $100,000, and that number doesn't require a VC to hand it to you. So the next time someone tells you to just raise money and figure out the tax stuff later, smile politely and then immediately call a tax attorney, because later has a funny way of becoming too late. The founders who win long-term are the ones who treat the IRS like a co-investor they never invited, but always have to appease. Capital is oxygen, but structure is the lung. And without a healthy lung, all that oxygen just leaks out into someone else's coffers. Build the thing right from the beginning, hold your positions with discipline, and remember that consistency in execution will always beat conviction in timing. Whether you're raising your first round or restructuring for your next venture, we can help you get started, whether that's real estate investing, home contracting work, or finding the right lenders. So check out our links in the description below.